investors are really hunting for some gold. So steel stocks are bright and they are shining. Sunil Subramaniam joins us, Managing Director and CEO with the Sundaram Mutual Fund. Sunil, season's greetings. Wish you and your team and your family a very happy new year.
Thank you, and wish all the viewers a very happy and fulfilling new year.
Will it be happy new year for mid and small cap investors, or will it be like one of those dull years?
No, I think this year we'll see the turnaround happen.
You told me the same thing last year also.
Yes, but you see, at the beginning of the year when you predict what happens, right? The slowdown was not predicted. See, one thing with mid and small caps, you remember, they are the ones closely linked to the economic growth. So you can't predict economic growth, right? So I think that from that perspective, again we retain optimism. That credit growth, that GDP growth will come back, right? So whatever I say, you have got to ultimately look at the economy growing. If the economy doesn't grow, then I don't think that will hold true. But I'm confident the economy will grow.
Okay, Sunil, the question on mid and small cap stock is, even though with the with the caveat here that I firmly believe that small and mid cap stock should make a comeback. But what, in a sense, keeps me guessing is that if I look at the bent of the economy, big companies are only becoming bigger, not in terms of market cap, but in terms of market share and profit. In this economic slowdown, HUL, ITC and Nestle have emerged as clear buyers.
Correct.
In this economic slowdown, Prestige Estate, DLF and Colte Patil and Oberoi has emerged as the survivors in the real estate sector. Jet has gone under and Indigo has got lion market share.
Correct.
So if the economy is going to migrate from small and mid cap businesses towards large and mega cap businesses, what is the case for small and mid cap stocks to come back? Because they are losing market share. Some of them are not capable. Some of them are poor asset allocation. Some of them are poor capital allocation.
Okay, so two aspects to what you said, Nikunj. All the names that you mentioned, the larger names, were once upon a time small and mid caps. So when you pick them at the small and mid cap, if they migrate into the large cap space, you're taking them out of the mid cap space and saying, oh, mid cap didn't give return. It is these fast moving multi-baggers which have delivered returns and hence are now part of the larger cap basket, and you are then looking. So it's basically the game theory. You keep taking out the cream, naturally the balance will do. So these were small and mid cap. So if you look at the returns that they were delivered when they were bought as mid caps, then you wouldn't complain about the fact. So there are always winners and losers in the economy. There is always consolidation taking place. But I think the mid-cap stocks which are going to become large caps, right, are the right picks. A mid-cap is going to remain a mid-cap for the next decade is not really the greatest mid-cap. So that's where when you track the indices, the 10-year back index composition and today's index composition will be a world of difference. So it's not fair to compare. If you take a mid-cap, take 10 years back and take a mid-cap pool then and track only those and don't change your indices, you'll still find that mid cap has delivered the best returns because some of them have become the fast growing multi cap. That's one point. The second point, when you talk about this whole consolidation play and all of that, the key is that you're looking at a very wrong point in time at the whole mid cap story, because when they are linked to the economic growth and the economy is going in a slowdown, naturally their core business is linked to the economy. Cement, steel, infrastructure, cyclicals, capital goods supplies. So when you look at the same story when the economy is in a boom, right, you will say, oh, mid and small caps are like, why do people invest at all in large caps? Mid and small caps is where they should put their money. So the end point, the point at which you're looking, that point to point return is what thing. Because if you then turn around and look at a lowering return concept, you will find that it's not as polarized as you say from a point to point. So I think these are the two key points I wanted to make. That is that today's large caps were yesterday's mid caps, and second, you're looking at a point in time when the economy is in a slowdown and then tending to beat down that segment. So I would say if you're betting on a recovery, it is that mid cap which is today available at a reasonable valuation, which will deliver far better returns to you than picking a story which has already played out as a large cap, right? I think that's the third. One small point to complete this story is, in such a slowdown time frame, we are in that kind of a space where in a slowdown, all world central banks are printing money. So when money tends to flow, it tends to concentrate into the large cap space. When those economies tighten and that money goes back into growth, then you commit as export orders for India, then mid caps again. So that's another third aspect to this play, is when there is excess liquidity, always large caps tend to play out because they play safety. Whereas when there is low, when the economy needs money, as American economy, European economy, then the money is going there, then you will get the spillover economic benefit, which will again benefit your mid and small caps. So I think these three filters I would like to point out to
Sure. Within steel, which is a sector which is just about moving, there are some positive data points coming in. SAIL as well as NMDC December sales have been quite smart on a year-on-year basis. There was a note by JP Morgan as well, which says that, expect price hikes to try and support the stock performance, and all the benefits will accrue in the March quarter earnings itself. Do you believe this is a sector to be bought? And again, within this, would you buy the smaller ones, or would you stick with the leaders of the pack, the Tata Steels of the world?
Okay, so there are two reasons why I would support this thing of buying this. One is steels are a part of global cyclicals, metals pack, right? And with the US-China trade war, if Trump is going to sign off a trade deal, that means China is not going to hurt. China is only come back and buy steel. So the price, so if you take a price into quantity ratio for steel business, the price was what hurt it badly. So that price element from an international, if there is any signs of recovery, metal prices should go up. So that should reflect automatically on steel companies' balance sheets. The second is steel very closely linked to cement and infrastructure. Because every concrete, whether a road concrete or a house in concrete, they go together. And the curious thing is, one is apart from the 100 lakh crore, spelling out which Nirmala madam did over the last week, but more importantly, in cement is where I would see the story for steel. Because one peculiar thing we notice that though cement production has been going down month on month, cement loans have been going up month on month at 15 to 16% YOY growth, which means cement companies are building capacity. Now, if they are building capacity, it's for a future supply. And everywhere cement goes, steel goes with it, right? You don't use cement as cement. Cement is used largely as concrete. So to me, in that, and so to your question on whether you buy the larger player or the smaller player there, I would say the smaller player, because they are more highly leveraged. They have been more beaten down. So purely from a valuation perspective, the business-wise, their business may not grow as much as the Tata Steel from a market share and all the perspective. But stock would move dramatically because of the beating down. So I think from that kind of a play, it's a very good play there.
JSPL production numbers as well, and they've clocked the highest ever quarterly production and sales in Q3. And this is in addition to what we saw from SAIL just yesterday, the data points. The December sales have showed up by about 47%, and NMDC as well, wherein the iron ore sales have come in higher by about 7% on a year-on-year basis.
No, Aisha, I think what we also need to recognize that within the metal space, the trade war fear is getting diluted. And, China has seen an uptick in their hot roll steel prices for 3 months on the trot now. And in India, you still have the huge advantage because you have a duty protection, and because of the duty protection, the Indian steel companies are still producing at a cost which is lower than the landing cost of the Chinese steel companies. So Chinese cannot dump steel and cement into India. Cement largely because it's a transportation issue. Okay. Steel because it's a matter of cost effectiveness. And I think our fiscal is in a mess. If fiscal is in a mess, rupee is not going to appreciate. If rupee is not going to appreciate, metal companies will have a ball because you put it right. They will actually have a ball because it's dollar denominated. But Sunil, my next follow-up question to be is that in last 10 years, for those who bought a Kotak Mahindra Bank, or for those who've really bought HUL, Page Industries, iShare, Bosch, excellent businesses, they've really hit a home run.
Really?
They've hit a home run.
Correct.
Right? If you really bet on a consumer bank or a retail bank, you've hit a home run. If you bought a good classic FMCG company like Nestle or HUL, you've made money.
Correct.
Will this thesis of buying quality business at any price change? And do you regret as a fund not really taking bets in some of these pockets?
Well, regret is always a very unnecessary emotion because it's the past, right? So yes, if we had made these picks bigger, then we would have made more money. So that's a very obvious statement of fact. But your question is in two parts, right? So one is, do you identify the multi-backers of the future, and then do you buy them at whatever be the price is the question. So I think that the answer to that is yes. The thing is that the new multi-baggers will be different because the last 10-year story and the next 10-year story, I think the last 10-year story was largely an opening up of the economy kind of a story where the reforms actually led to the slowdown because we are not used to this efficiency. The inefficiency getting cut out of the system has led to the slowdown, I would say. But the next 10 years is clearly the demographic dividend. I mean, I know the demographic has been talked about a lot, and played out a lot, but it's actually going to come down in harsh reality in the next decade. And so all those services and products which are going to cater to a lower to upper middle class. So I would point out here financial services like AMCs, insurance, telecom, anybody that is going to be used, because India is going to be a scale market as opposed to a niche market. That difference, so anybody who's a scale player, and that's why the telecom battle and then the winners means that they are, for the next 10 years, they are going to be data, telecom increase is going to be there. The second aspect of it is the rising per capita income. It may not rise as fast as we expect because of the pressure of the same population, but the fact is that the people will either choose to save or to consume, right? So products on both sides. See, the consumption in India, the mentality is always to save first and then consume, right? Because there's no safety net. So I would say the rising comparison, I would still say that while consumption will grow, I would say people's expenditure on items which are low ticket would be much higher because they won't feel the pain or pressure of spending that money. So that's why I bring my point down again to the services segment, right? Low cost services to mass market is going to be the big story of that. And the key there is also that this advantage may not necessarily accrue to Indian companies. There will be foreign companies coming and taking advantage of these. So from a stock market perspective, you've got to be careful. Chinese are dominating our mobile market. The stock market is not able to really take us. So that's the only thing which would, well, the economic growth will be there. Whether all of those will participate in the stock market is the key situation that we need to observe.
Sunil, great to have you in the studio, and a very happy new year to you and your entire team at Sundaram once again. Okay, as we enter the 2020, Sunil Singhania of Abacus Asset Managers shared with us his strategy and outlook for the coming decade in a freewheeling chat. Let's hear out what his predictions for the year ahead were.